This week is going to be crazy. We have not one, not two, but three major central banks deciding on monetary policy. Starting with Japan, tomorrow, the Bank of Japan will be deciding whether to hike interest rates as well as to a timeline when they're going to start quantitative tightening. And if that's the case, the yen is likely to strengthen further, which will unwind the carry trade. And if that's the case, the yen is likely to strengthen at the expense of the dollar. Now, at 2 a.m. Singapore time on Thursday, we have the Federal Open Market Committee, what we call the FOMC, in which the Fed will be deciding whether to do anything with their interest rates. There's no expectation, but market will be looking towards the language used by the Fed chairman during his post-meeting conference, in which he will likely be telling us as to whether there will be a interest rate cut come September. Market is expecting 1 to perhaps 2 rate cuts this year. And then at 7 p.m. on the same day on Thursday, we have the Bank of England deciding whether to cut interest rates. Market expecting them to do so with a 25 basis point cut, bringing the UK interest rates from 5.25% to 5%. If this is the case, the sterling will be negatively impacted, and of course, the dollar will benefit. Then on Friday, we have perhaps the biggest and most impactful data-driven event, which is the US non-farm payroll numbers. Now, for the month of June, there were 206,000 jobs being created. Market expecting for July, there will be 175,000 jobs. If there's going to be any downward revision in the June or even the July number that came in lower than expected, the dollar is likely to be negatively impacted, because that will give the Federal Reserve the fuel that they need to actually go ahead with interest rate cuts. So do watch out for Friday, because that will be impactful as well. One way to take advantage of the expected volatility in the dollar itself is to trade the mini US dollar index futures traded off of the Intercontinental Exchange, what we call ICE, which is based in Singapore. And if you're interested, I'll be more than happy to share with you my views of the directional bias of the dollar across different time frames. Here we go. Today is Tuesday, July the 30th, the second last business day for the month of July. And it's about time we talk about the dollar. Like I say, this week is going to be crazy. So let's get on it. Now, the contract specification for the mini US dollar futures is actually here. You can see the product code is SDX, and the contract size is $200 times the index value. And the trading hours is very early at 8:30 Singapore time, all the way to Saturday at 6 a.m. And the minimum price fluctuation is 0.005 equal to $1. And the listed contracts are all the every quarter. We can see that we have March, June, September, December on a quarterly basis. And the settlement method is by cash settlement. The last trading day, obviously, is 7 p.m. Singapore time, 2 business days prior to the third Wednesday of the expiration month. And the maintenance margin, do check with your brokers, because the brokers may actually differ. Do check with your brokers for that as well. And this is the cash index for the US dollar index, which is very different from the futures contract, but this is the cash index itself. We can see that this market is based on the monthly time frame going back all the way to 2008. We can see that generally speaking, the dollar has been trending higher, although the market hit a peak in September 2022 at 108.825, and the lowest traded was in December last year at 100.32. Currently, the market settles at about 104.359, and this is as of this afternoon. So this is the general direction of the market. The dollar is basically trending higher. And then on the weekly time frame, this is referencing the mini US dollar index futures for the September contract, because this is the most active contract currently. We can see that in the weekly time frame, the directional bias is actually favoring the downside. The high traded at 114.605 is actually the high, and since then the dollar index has been trending more or less sideways with a little bit bias to the downside. Lowest traded was 99.265, and we can see that the market is moving with lower highs and higher lows. We can see that this is a situation in which the market is consolidating. So there is no major trend as we are speaking right now based on the weekly time frame. Now let's take a look at the daily time frame. Now in the daily time frame, we can see the dominant trend is down because the bigger box here is the pink color box with a counter trend in place at 100.43 with a high traded at 106.305. And we can see this market is basically moving inside this bracket of prices. Now, if the market do trade lower into 102.39 to 103.2005, that will actually offer us a very low risk buying opportunity. However, if the market do trend higher into 106.28 to 107.78, that will actually offer us a counteracting low risk selling opportunity. So based on what we see so far, the dollar has been relatively strong this past week itself, and it's likely to continue to trade higher. Again, everything could change in the GIF depending on the monetary policies of the various central banks that will be active this coming week. So on the downside, lower to buy, on the upside is higher to sell. The market is basically trading in the sideways pattern. So there is no risk that the dollar is going to run away. So this is my outlook for the dollar going forward. And I wish you guys happy trading.